the narrative that you hear is not consistent with the outcomes that we've seen.
That's one side, that's one argument. You could have another column saying all the positives.
Have a higher allocation to China, lower. Do we buy Argentina? Do we buy Greece? What do we do, right? And you have to make a judgment call. China has increasingly expanded its trade. The US are not in a particularly good situation either because they don't produce anything anymore. All of these roads lead to significant inflation.
Long question on China. For our energy and materials themes, I'm particularly concerned about China's economic health. Could you provide some insights on this? Here are some of the major issues I'm worried about. Terrible demographics, debt crisis, property crisis, leadership shift. Xi Jinping's leadership resembles Maoist approaches, moving away from business-friendly policies, creating economic repression. Wealth and talent exodus, people leaving. And reliance on globalization, heavily dependent on US-backed global trade for importing energy and food and exporting goods. The system's potential decline poses a major risk. And that's from Frey.
And that's what's been priced into the markets. Look at the S&P 500 valuations, look at the Shanghai Composite. The Shanghai Comp is half or 40% of the valuation of the US market. It's somewhat cheap. I think that's one side, that's one argument. You could have another column saying all the positives.
It sounds very much like, who's that geopolitical analyst who's basically a CIA operative? He's gone off on his own. And the gay guy with the ponytail.
Zihan.
Peter Zihan.
Peter Zihan. This sounds exactly like a Peter Zihan argument. Yeah. Here's the thing. I've spent the last 15 at least years listening to people like him and other people saying any minute now it's going to collapse. It's on the brink of collapse. It's on the brink of collapse. I've been listening to that for 15, 20 years.
Another one, right? Kyle Bass is another popular critic of China.
Yeah, I mean, Kyle, I don't know whether he's got his own capital. Peter Zihan's just a twit who doesn't have any understanding of economics. But nevertheless, the narrative that you hear is not consistent with the outcomes that we've seen. At some point, one needs to look at something and say, okay, and we need to do this the same ourselves. We do it all the time. Like we'll have a particular set of information that comes in and Brad and I got to decide, what are we doing with this? Do we have a higher allocation to China, lower? Do we buy Argentina? Do we buy Greece? What do we do, right? And you have to make a judgment call. And you're always making a judgment call with insufficient information because we can't possibly have all the information that's out there, right? So at some point, you would think that a lot of these geopolitical analysts, quote unquote geopolitical analysts, would look and say, I've been wrong for 15 years. Maybe I'm missing something, but they never do. So that's the first thing. And at the same time, China has increasingly expanded its trade. It increasingly has expanded its trade surpluses. They're sitting on about just under $1 trillion in US treasuries, which they've also been diverting a lot of that out of treasuries, but they have literally so much surplus coming in, they have to keep, to some extent, buying treasuries for liquidity purposes alone. Economically, they're crushing it. They are absolutely crushing it. The middle class in China exists now. I went there, mid-2000s, and the difference, and it was at the time, it was shocking actually how wealthy it was comparative to what I've been told. I was like, oh, this is the backward Chinese, and you can't travel anywhere because of the Chinese Communist Party. And I traveled all over the country. People were friendly, and there was a lot of economic activity. Anyway, I realized very quickly that a whole lot of the stuff I've been taught, and people I'd been working with investment banks in London had the wrong information. And I was just spending 2 months or whatever it was on the ground. Subsequently, it's gotten even better. Anyway, the point is, I take with a pinch of salt pretty much any information about China coming out of Western media, whether it be Reuters, Bloomberg, or any of these people. I also take, to some extent, with a pinch of salt, the same information coming out of Chinese state media. I don't trust them either. But I do look at just the economic indicators. So it's proven to be a bad strategy to be short China, and I think it will continue to prove to be a bad case or bad choice. But the other element behind it is that, and you mentioned this, Brad, if this is true, or it's already priced. It's already priced into the market. So there's our downside. Now, if it's not true, then there's a whole lot of upside. To what degree, we don't really know. But if you look at Chinese equities right now, they're very under-owned, certainly by Western capital. They're extremely cheap. And just before we got into this particular webinar, we were talking, or before we hit record, about something that I noticed last night, which is that the Chinese bonds are now the yield has been collapsing. And you say, well, what does that mean, Chris? That doesn't mean anything to me. It probably means that they are going after a highly stimulatory economic environment, i.e. QE to infinity. The 10-year, and this is almost unprecedented, went from in 2021, it's trading at about 3.3%. It's now trading at 1.7. It's an absolute collapse in yields. It's just massive, expansive fiscal and monetary policy. It is something I'm going to write about in the next issue, not the one that you'll get, which Mihai is now, but the following one. And it is something that you could look into, which is called Irving Fisher debt deflation spiral. To me, it looks quite similar to, this is what basically they're pursuing. And they pursue it where you've got a domestic over-indebtedness, which they do have to some degree in the banking sector. And what you basically are looking at is a significant destruction in or debasement of the currency. You could say, oh, that's bad for China. Not really. They can debase their currency because they're a net exporter. Okay, so it actually makes them even more money, especially if they're earning money in dollars, not in yuan. They can debase their local currency, right? Because all of their OPEX is in their local currency. Now, I don't know if this is taking place because they see the incoming Trump administration, where Trump's come out and said he's going to slap 100% tariffs on them. So imagine you slapping 100% tariffs on the Chinese and they just go and devalue their currency by 20%. Guess what? You basically, they just won the game. Like they just took your lunch. Now, I don't know if that's their strategy and if that's what they're doing ahead of his incoming administration, or if they're doing it for domestic reasons. But the net result is ultimately the same. And the net result is that you have a global debasement of fiat currency, because at the same time they're doing this, the Europeans are doing the same thing. And the US are not in a particularly good situation either, because they don't produce anything anymore. All of these roads lead to significant inflation, if I'm accurate in this. And it's a total debasement of global fiat currency. So you say, well, what do you do in that situation? I'd like to think we have a lot of the assets that we've been buying, or the sectors we've been buying, goes some way to hedging that particular outcome.
Going back to Frey's question, I would wonder when did you start thinking this, Frey? Because a lot of the issues that you've listed are not new to China, and people like Chris and Brad have said have been talking about it for ages, and it's all priced in. And if you look at most of this list, you could replicate this list for many other countries. So relatively, is it actually a standalone dying economy when a lot of what you've written here is the same in Western countries? And
I mean, if you just take, for example, what's happening in the EU, right? So, and again, when you get the next insider issue, you're going to have a bunch of this. So like you've got the Dutch are coming out with an exit tax, right? So if you leave the country, that's going to steal your assets. You know, the French are coming out with an increase in the taxes. The Brits are increasing taxes, and now they've got rid of the non-dom rule. So that's now seeing capital fleeing. I just saw an article the other day that the London Exchange has had the biggest net outflow of companies delisting in its history. So you're looking at all of these Maoist policies taking place across Western Europe in particular. Now, if you then look at valuations of those companies in Western economies, Western Europe in particular, and you contrast it to what we're looking at in China, it's obvious, like there's a massive imbalance. If both of these are actually communist Maoist regimes, surely you'd buy the one that's cheaper, right? So it's not just a matter of where things are going, it's also a matter of how is it priced? How is Europe priced right now? How is China priced right now for the actual realities? And it's clear to us that most Western capital has fled China. In fact, we saw this, Brad. We were talking about it with our dividend income portfolio, which we hold roughly about 12-15% of that is in Hong Kong listed equities. And even when we had this massive flight of capital out of China, our stocks went up. But largely they went up because they're medium to small cap companies which are domestically owned. They're not owned by large institutional Western capital like your BlackRocks and your State Streets and your Vanguards. Those guys all fled, but they never owned the stocks that we own, so it didn't matter. Now that they've fled, where did they flee to? Well, they probably fled into some European equities, some US equities. They probably went into the Magnificent Seven. They probably bought some more Nvidia, God knows what. Question now is, well, is there more downside to things like KWeb, which we've just been buying? We like to think it's probably priced in.
There's actually a trade alert on that coming out too within the next few days too, folks, on KWeb. The other thing which I want to mention here, Chris, is remember when we bought Argentina back in 2021? You could hear a pin drop, whatever, when it came to bullish commentary on Argentina. Nothing. And people, it's so bad that, like, recall we had some clients who were from Argentina, and we said, oh yeah, actually we're going to invest probably 5-7% of your portfolio in Argentina. Like are you guys mad? Like, you're nuts. Anyway, the point being is that the best time to invest is a point of maximum pessimism. You will not find any bullish commentary, and all the commentary out there will be justifying why the market has done so badly. So always remember that commentary usually follows what the price has done.
Narrative follows price. Then people go, oh, it's gone down. Now I need to figure out why it's gone down. And then they come out with a narrative, and everyone goes, yeah, right. That's it.
Yeah, genius.
But like, too late. Too late, brother. You already missed the boat. Yeah, look, I mean, I think it's entirely possible we're a couple of years early. I don't know. But that's fine. I mean, we were a couple of years early on Argentina. I'm okay with being a few years early, if that's the case. I'm not sure it is, but again, if you make it a small 5% or something allocation, then you've got the ability to navigate things without getting emotional about it and be rational about what's going on.